Today we are going to discuss about the preparation of revaluation account, capital account, balance sheet, which is basically from the admission chapter. Other chapters also these accounts are there, such as retirement, death, and change in profit sharing ratio. So without further delay, let us jump into the question, along with which we will discuss how to prepare these accounts. So as you can see on the screen, there are three partners, Divya, Yasmin and Fatima, sharing profits and losses in the ratio of 11:7:2, that is the profit sharing ratio, and the balance sheet on 31/3/2018 is given, where you can find the amounts like creditors are there, public deposits are there, reserve fund is there, outstanding expense, capital account, like that. All the assets and liabilities are given. When you get such a balance sheet, okay, this is the shortcut again. When you get a balance sheet like this, in the case of admission chapter or retirement or death or change in profit sharing ratio chapter, what you are supposed to do is you search for reserves, any reserves that is given there, or any profit and loss account that is mentioned either on the asset side or liability side, and advertisement suspense account. This account can come in different names: advertisement suspense account, advertisement expenditure account, deferred revenue expenditure account, deferred advertisement expenditure account. All these are names of the same thing. So you just focus on the word advertisement. Mostly it will come as advertisement expense or advertisement suspense account. Okay, so check for these amounts. And goodwill account. Okay, these four things, is what you are supposed to check in the given balance sheet. These four amounts will go to the existing partners capital account in their old profit sharing ratio. I'll repeat, these four amounts, if any of these amounts are there in the given balance sheet, what are you supposed to do? You are supposed to transfer it to the partners capital account. Which partner? The partners who were there before the change that took place in the partnership. That means here, as you can see, Aditya is admitted as a partner. That means it's a obviously, as I mentioned in the introduction part, this is actually a question from admission chapter. So Aditya is the new partner. So before Aditya came, who were there? There were three partners: Divya, Yasmin and Fatima. So these partners who were there before such changes that happened in the partnership will get a share of all these things in their original profit sharing ratio. Original means their old profit sharing ratio, that is 11:7:2. As you can see here, 11:7:2. This is a ratio in which you have to share all these things. That is the main purpose of this balance sheet which is given here. One of the main purposes of the balance sheet which is given here. Now I am taking all these things out again. As you know already, the one person is admitted for 1/5 share in the profits with a capital of 4,50,000 and necessary amount for his share of goodwill on the following terms. So basically what they are saying, when a person comes from outside as a new partner, he has to bring capital, obviously, because he is going to invest some money in the business, then only he will become the partner usually. The next is also he has to bring some amount as a compensation to give to the other partners who are sacrificing their share of profit hereafter for him. That means if suppose three partners are there, A, B, C, okay, they are going to admit D into the partnership. Admit means obviously D is joining the partnership. Obviously A, B and C, most probably all of them will sacrifice some amount of profit in favor of D. So it is D's duty to bring some compensation to give to A, B and C. The compensation is basically calculated on the basis of goodwill, and the compensation can be called as premium for goodwill. What do we call that amount? Premium for goodwill. Many of you are familiar with all these terms. I am just trying to make the concept clear for you. Okay, so that is premium for goodwill. So here basically who has to bring premium? Aditya has to bring premium. That is why it is here, it is mentioned as necessary amount of his share of goodwill. Then you can see certain terms and conditions that happened or that should be followed at the time of Aditya's admission. Furniture of 2,40,000 were to be taken over by Divya, Yasmin and Fatima equally. So first adjustment is about the partners who were there before the admission, Divya, Yasmin and Fatima. They are taking some furniture equally. Next is a creditor of 7,000 not recorded in the books to be taken into account. So they are talking about some creditors who are supposed to be taken into account. Then goodwill of the firm, as you studied already in your change in profit sharing ratio chapter. Along with that, just before that chapter, you must have studied a topic called goodwill calculation, where you are using average profit method, super profit method, capitalization method, all these kind of methods for calculating the amount of goodwill. So similarly, they are saying here goodwill should be calculated on the basis of 2.5 years purchase of average profit. Why we need this goodwill? In the introduction part I told, because based on this goodwill only we can calculate how much compensation D should bring. That is what is the name of the compensation? Premium for goodwill. Premium for goodwill. So for calculating that, first we need to calculate the goodwill of the firm. Goodwill of the firm calculation can be done using any of the methods: average profit, super profit, or capitalization of average or super profit methods. And weighted average profit also is there. So generally average profit and weighted average profit are coming under the same category. Okay, average profit method only. So it's a subcategory of average profit methods. Okay, so anyways, without further delay, let's go to next adjustment. At the time of Aditya's admission, Yasmin also brought 50,000 as fresh capital. Yasmin, who is Yasmin? Already existing partner. He or she is going to invest what? More money into the business. Already she has some capital. Along with that, she is bringing additional capital. Now last adjustment or last terms and conditions, last term, plant and machinery is revalued to 2 lakhs and expenses outstanding were brought down to 9,000. They are talking about one asset revalued. Okay, so I was waiting for this word to turn up to discuss about one account that you are going to prepare for this. Basically in this kind of question, what was the question? Prepare revaluation account, partners capital account and balance sheet. In the case of any changes that happens to the partnership, we have to prepare 3 things. Usually we have to prepare 3 things. First account name is revaluation account. Second, we have to prepare partners capital account, and finally the balance sheet. So what is the purpose of revaluation account here? Revaluation account is an account. In simple terms, if we say revaluation account is an account that is used to record the changes in the value of assets and liabilities. Okay, in the case of what? In the case of reconstitution of partnership. Now the question is, what is reconstitution of partnership? It is nothing. Whenever there is a change in profit sharing ratio of the partners, whenever there is an admission of a partner, whenever a partner leaves the business, whenever a partner dies, in all these situations, the structure of the partnership is actually changing. Okay, so basically the existing partnership deed will be cancelled and the new partnership deed should be made. Okay, so in all these situations, we can call all these situations as reconstitution of partnership. So in any of these reconstitution of partnership situations, we have to prepare revaluation account, partners capital account and the balance sheet. Revaluation account is prepared to show at the time of reconstitution of partnership, we will check what are the changes that happened in the existing assets and existing liabilities. So we will find that sometimes assets value has gone up, sometimes assets value must have gone down. Similarly, liabilities value may go up or might have gone down. So to record these changes in the values, we are not recording the new value or we are not recording the old value. We are only recording by how much it has increased or decreased in revaluation account. So basically that is what is the purpose of revaluation account. Now when it comes to the format of revaluation account, already you must be familiar with that. Debit side is for decreasing in assets and increasing in liabilities. If any liability increases, you have to record it on the debit side of revaluation account, and any asset decreases also you have to record on the debit side of revaluation account. Similarly, if any asset increases, we have to record it on the credit side, and also if liability decreases, we have to record it on the credit side. After recording all these kind of changes, you will get a balance in the revaluation account. Generally there are questions where there is no balance also. Okay, but generally when you record all these changes, there will be a balance either on the debit side or on the credit side. That means if the debit side total is more and credit side total is less, then that difference is actually called as revaluation loss. Okay, and that loss should be transferred to partners capital or current accounts in their profit sharing ratio. So here also remember, when we prepare revaluation account, only the existing partners who were there before the change, here who were there before the change, when Aditya came, the partnership has changed. So before that only three partners were there, Divya, Yasmin and Fatima. So these three people will be getting a share of that loss in revaluation account. Similarly, if the debit side is less and the credit side is more, it is actually called gain on revaluation. That also will be distributed among again the same three people, in which ratio? In their existing profit sharing ratio, that is 11:7:2. Okay, so that is all about revaluation account. So first we need to, anyways we are going to prepare revaluation account only first, so let us prepare that, after which we will discuss the other adjustments. So I am just drawing a revaluation account very quickly for your understanding. Okay, revaluation account. This account will not begin with any balance brought down and all. There is no opening balance and all. What you are supposed to do is just record the changes that happened in the asset and liabilities. So first we need to sort out or find out how many transactions are related to asset here. 1, 2 and 5. First adjustment is what? Furniture of rupees 2,40,000 were to taken over by D, Y and F. Hereafter I will be calling the partners with their first letter. So D, Y and F equally. What do they say? These partners are taking the asset. Did they say that assets value increased, assets value decreased? Nothing is there. They are saying furniture of rupees 2,40,000 was taken by these three people. So first we will go and see what was the value of the furniture given here. 2,60,000. From 2,60,000 they are taking asset of 2,40,000. So will it come in revaluation account? What did I tell? If the asset value changes only, it should be shown in revaluation account. So this won't come. Now two more transactions are remaining where they talk about assets and liabilities. So second one is a creditor of rupees 7,000 not recorded in the books to be taken into account. What does that mean? Here there is a creditor not recorded in the books. Such kind of things which are not recorded in the books. Not recorded in the books basically means in this given balance sheet that value is not included. In this given balance sheet that value is not included. That is the meaning of that. Such amounts are called unrecorded asset or unrecorded liabilities. Here it is creditor, so it is an unrecorded liability. So unrecorded liability, whenever it comes, what are you supposed to do? Same like if a unrecorded liability is there, we have to record it as a liability again. When we record it as a liability, obviously liability will increase or decrease. Yes, you are right. Liability will increase. So liability increases means in revaluation account which side? Obviously, as we discussed before, it should come on the debit side to creditors. You can mention the name of the liability here. And revaluation account, as we discussed before, revaluation account consists of the changes that happened in assets or liability. Here how much it is changing? 7,000 was not recorded, so 7,000 will increase, right? So that how much, by how much it is increasing or decreasing only we have to record. So we have recorded it at 7,000. Now coming to this next adjustment, plant and machinery is revalued to rupees 2 lakhs. Plant and machinery is revalued to rupees 2 lakhs. So here they are saying the new value, when they are using the word 2 and all, it means that this value is actually the new value of the asset or liability. So new value of asset and liability. So as you can see here, already plant and machinery was 1,80,000, now it is 2 lakh. So how much it is increased? Obviously it is increasing only, so it is increased to 2 lakhs, 20,000 increase. So 20,000 only we have to show in revaluation account. How will we show? Asset is increasing, so credit side, plant machinery account 20,000. So that is also done, and expenses outstanding were brought down to 9,000. As you can see here in the this part, there is an outstanding expense given in the balance sheet. That was the value which was given there was 10,000. We are bringing it down to 9,000. What does that mean? 1,000 should be decreased. Outstanding expense already you know it is a liability. So that liability should be brought down. Brought down means liability is decreasing. Which side of revaluation account? Obviously this side. By what will you write? The name of the liability here. What is the name? Outstanding expense. So same name we can write here by outstanding expenses account. By how much it is decreasing? It should be brought down to 9,000 is the adjustment or term condition that is given there. So obviously 1,000 will be decreased. After this you need to check, is there any asset related adjustment remaining, asset or liability related adjustment remaining, asset changes. As you can see, there are no other adjustments or points which mentions about assets. Okay, third point is actually goodwill calculation. Remember that goodwill will never come in revaluation account, no matter which goodwill it is. The goodwill which I was talking about before, that is sometimes inside the balance sheet also one goodwill will be there, and outside the balance sheet also they will be talking about some goodwill. So both the goodwills have nothing to do with revaluation account. It will never come in revaluation account. Okay, so now coming to this one. Okay, now as we know that all the things are done in revaluation account, what is the next step? You just have to balance it. So credit side total, as you can see, credit side is more, so I am just writing the total here before itself. Okay, 21,000. Now as you can see here, how much is less? 14,000 is this. So as credit side total is more, we can call it as gain on revaluation, and that gain will be transferred to partners capital account or current account. According to the method they are using, capital account or current account will consist of these amounts. So capital account, I am just writing the short names of these three partners. Who are the partners? Divya, Yasmin and Fatima. Why Divya, Yasmin and Fatima? Only these people will get, as I told before, the partners who were there before this change only will be getting these amounts. So how they will divide this? How much is the difference? This difference is 14,000, 21,000 minus 7,000. So you will get 14,000. 14,000 will be shared by Divya, Yasmin and Fatima in which ratio? Obviously in their existing profit sharing ratio. That means 11 by, what was the ratio? 11 is to 7 is to 2. That means 11 by 20, 14,000 into 7 by 20, and how much? 2 by 20. So how to calculate? Here first person will get 7,700. Second person will get 4,900, and third person will be getting 1,400. Totally 14,000 will come. Hope that is okay for you. Okay, so basically that is how we are preparing revaluation account. So remember that revaluation account consists of only the changes that happens to assets and liabilities. I have already prepared a capital account. Though we have prepared revaluation account, like what to say, in front of you. Okay, I have already prepared a capital account in which I have recorded all the amounts. So capital account, when you prepare, remember that always it will start with an opening balance. Okay, opening balance. From where we will get the opening balance? Opening balance is available in the given balance sheet, which is basically this 5,10,000 and 3 lakh and 5 lakhs. Okay, and next thing that you are supposed to do is, obviously we are supposed to write old amounts. That means the reserves and all which we were talking about in the beginning of the question. Reserve 90,000 should be distributed to the partners. Which partners? Partners who were there before the change that happened. So basically we are dividing this 90,000 in which ratio? In their old ratio. That means 11 is to 7 is to 2. When we are dividing this 90,000 in 11 is to 7 is to 2, you will get these amounts: 49,500, 31,500 and 9,000. And next thing, as you can see here, is revaluation account. From where the revaluation account came? We have already prepared the revaluation account and found the profit. So how will you convert it into entry? Revaluation account debit to D's capital. That means Divya's capital, to Yasmin's capital and to Fatima's capital. Okay, so these three people's capital account is credited with that this revaluation profit 7,700, 4,900 and 1,400. You can see here one bank is written. Basically what does that mean? Okay, here one partner is bringing capital. How much? 4,50,000 capital. And 4,50,000 is recorded here. Okay, again one more by bank you can write. Okay, and mention whose capital. One more capital is there. Whose capital? One more person is bringing additional capital. What is that? At the time of Aditya's admission, the Yasmin also brought 50,000 as fresh capital. So that 50,000 fresh capital also should be mentioned in Yasmin's column. You can, instead of writing these two bank accounts, you can write together also here itself. Along with this bank account in Yasmin's column also you can write 50,000. Then next amount is basically, so to capital entry is done. Next is actually sharing of goodwill entry. Sharing of goodwill entry is what? First partner has to bring goodwill, the premium for goodwill. So what is entry for that? Bank account debit to premium for goodwill account. Basically what does that mean? Partner is bringing premium from outside. Okay, so after that we have to share this goodwill. So sharing goodwill is related to capital account only. Premium for goodwill account debit to sacrificing partners capital account. So now what is sacrificing partner, or who are sacrificing partners? Here as you can see, D, Divya, Yasmin and Fatima are sacrificing partner. Why? Because if the question does not specify who is sacrificing clearly, that means if the question does not specify how much how this new person has got this share, as you can see, new person share is 1/5 share, right? So how we achieved this share, or from whom he got this share, that means no additional information is related to what is it, the new share or the person's share is given. A new partner is coming into the business, so his share related no information is there in the question. So in that situation, basically it is assumed that all the other partners, that means whoever is remaining there, all of them have sacrificed, and the ratio in which they sacrificed is the same ratio like their existing ratio, that means 11:7:2. I'll repeat, if a new person comes and his share is given in the question but no additional information how he got that share is given, then it is taken as sacrificing ratio is same like their old ratio, that means existing partners old ratio. So basically what is sacrificing ratio? If any partner sacrifices his share of profit in favor of another person, if you put that sacrifice together in the form of a ratio, that ratio is basically called sacrificing ratio. So basically it is the duty of the newly coming partner to share some compensation with the sacrificing partners in this 11:7:2 ratio. That is, that compensation is basically called goodwill or premium for goodwill. Okay, so this goodwill we are calculating using a method. What is the method? Already you know, here for goodwill calculation they have mentioned goodwill of the firm is valued at 2 years purchase of the 2.5 years purchase of average profit of last 2 years. So basically last 2 years profit, average profit, okay, we have to take out and we have to multiply it by 2.5 years purchase. So that will give you the goodwill of the firm. So first we will try that. You already studied average profit method, total profit divided by number of years. Here how many years total profit we have to take? Last 2 years. How to find out of these 3 years which is last 2 years? Take the latest 2 years. You can check the balance sheet date. Which is the balance sheet date? 31/3/2018. So 31/3/2018 means obviously 2018 is the latest year. So this 2017-18 and the previous year 2016-17, these two values are the latest. So 6 lakhs plus 2 lakhs all divided by 2. So how much you will get? 4 lakhs. What is this value? 4 lakh is average profit only. We need to find out the goodwill of the firm. So 4 lakh into number of years purchase. It is 4 lakh into 2.5, 10 lakhs. 4 lakh into 2.5, 10 lakhs. 10 lakh is the amount. Is it the amount that Aditya has to bring? No. 10 lakh is the total goodwill. We need to find out Aditya's share. That is 1/5. So Aditya will bring 2 lakhs. This 2 lakh belongs to whom? All the other partners, Divya, Yasmin and Fatima. In which ratio they will share? 11:7:2. Why 11:7:2? This is the sacrificing ratio in this question. This is the sacrificing ratio in this question because no additional information related to the new partner's share is given. 11:7:2 ratio, we are going to divide that. I'll bring the question. So as you can see here, I'll show the question. So basically again 11:7:2 ratio, we are going to divide this profit. So coming to this, so when we divide it in 11:7:2 ratio, we will get premium for goodwill as 1,10,000, 70,000 and 20,000. Okay, that we have divided. What is entry for sharing goodwill? Premium for goodwill account debit to partners capital account. Which partner? Sacrificing partners capital account. So that is also done. This is also bank bringing capital is also done, and additional capital introduced is also done, revaluation is done, reserve fund is done. Now as you can see here in the capital account, you can see two furniture which is mentioned here. What is that? When we are doing revaluation account, we actually didn't consider one adjustment, right? Didn't consider one adjustment. What was that adjustment? The furniture of rupees 2,40,000 were to be taken over by Divya, Yasmin and Fatima. So 2,40,000 rupees furniture partners are taking. So that amount should be debited to their capital account, which is 80, 80, 80. 2,40,000 taken by Divya, Yasmin and Fatima equally means obviously it will be divided by 3. So we are writing 80, 80, 80 in their partners capital account. After doing all these things, after making sure that we have recorded all the amounts, we are finding out the balance of this capital account, which will give you 5,97,200, 3,76,400, 4,50,400 and 4,50,000. Everyone is everyone knows how to calculate the balance. Add all these things. If you want to calculate Divya's balance, 5,10,000 plus 49,500 plus 7,700 plus 1,10,000 minus 80,000 minus when you do that, you will get 5,97,200. 5,97,200, then 3,76,000 and 3,76,400 and 4,50,400 and 4,50,000. After recording all these things, what is the next step? I have already prepared a balance sheet, okay, which is almost done. We are just, okay, I will just explain how it is done. So basically, first amount, how to prepare the balance sheet is, you just go to the old balance sheet which is given there and you just check the old balance sheet. As you can see here, old balance sheet, sundry creditors is there, 70,000. So first you have to check in the old balance sheet if there is any value that changes. So sundry creditors, as you know, we have recorded some unrecorded creditors here in the revaluation account. As you can see, creditors is increased by 7,000. That means when you are showing here, you always should show the asset and liabilities in the latest value. If there is no latest value available, then you can show it in which one? The old value. So here latest value is there, 77,000. New value only we have to show here. In public deposit, from where the public deposit came? In the old balance sheet there was a public deposit, but in nowhere in the question they have mentioning about any change that happened to public deposit. So we will show the same value here, 1,19,000. Next is outstanding expenses. What is the adjustment related to outstanding expense? 10,000 was there. Outstanding expense should be brought down to 9,000. That means 1,000 we have already decreased in which one? In revaluation account we have shown 1,000 decrease. So 1,000 after decreasing 1,000, before it was 10,000, now we are showing 9,000. After that, next amount that you can see in capital account is basically three capital accounts, 5,10,000, 3 lakh and 5 lakh. This is not the amount that we are going to show. We are going to show the other, all the partners capital account, which balance? The balance carried down which you got now, 5,97,200, 3,76,400, 4,50,400 and finally 4,50,000. We have copied that amount. The total will come as 18,74,000. Now coming to the asset side, before going to asset side, always make sure that there is no unrecorded liability yet to be recorded. There was one unrecorded liability, which was that a creditor of 7,000 not recorded. But now we have added that amount to already existing creditors, so there is no unrecorded liability left. Now coming to the asset side, first amount is factory building. Is there any change to factory building here? According to the terms and conditions that is mentioned here, no, there is no change. So we are recording the same value here, 7,35,000. Then plant and machinery, is there any change? Obviously plant and machinery is revalued to 2 lakh. As you can see here, plant and machinery is revalued to rupees 2 lakh. So that amount you have to show. Next is what? Furniture. Furniture, as you can see, furniture is taken by D, Y and F. I will just take their first letters itself, D, Y and F equally. So obviously there were 2,60,000 rupees furniture, out of which already they have taken 2,40,000 furniture. So how much is remaining? 20,000 only is remaining. So 20,000 will be mentioned here. Okay. Before that, let me tell you one more thing when it comes to liabilities. Here in the old balance sheet, as you can see, there is a reserve fund here which we didn't record now. Can you tell the reason? Obviously, reserve is something that we already distributed to the partners. In the credit side, we have already returned reserve fund, right? In the capital account, we have already returned reserves. So here you can see reserve fund is mentioned. That is the reason why once it is already given, there is no value to it, right? It's already gone. So that is why we are not recording it. Okay, I just added it for your information. Okay, why we are not recording it? Most of you must have had that doubt now till now why I didn't mention about reserve. This is the reason why I didn't mention. It is already recorded there. Okay, then and in stock, as you can see here, stock, is there any change? 1,45,000, there is no change. Then again, debtors, there is no adjustment related to debtors. There is no terms and condition which talks about debtors. So same value we can mention there. Last adjustment is, or last amount is cash at bank. When you are recording cash at bank, always be careful. All the entries that are coming in this question related to cash or bank should be considered here. I will repeat, all the journal entries which are related to cash or bank should be considered here. Clear? So in that case, how we are supposed to do cash at bank is, as you can see here, 1,59,000 was already there in cash at bank. Okay, as you can see, we have passed journal entries, or when we discussed how to record the transactions in capital account, we have discussed when a person is bringing capital, what is the entry? Bank account debit to whose capital? That person's capital. And when a person brings premium, what is entry? Bank account debit to premium for goodwill. These two entries we have discussed. Anyways, again, okay, if you didn't listen, remember that there are two entries when it comes to bringing premium and also capital. So when a person brings capital, bank account debit to that person's capital. Here Aditya's capital will come. That is the reason why in his capital account, what did we write? By bank, and we wrote this 4,50,000 there. Okay, 4,50,000 there. And premium, when you are bringing premium for goodwill, what is entry? Premium for goodwill is nothing, the compensation that you are bringing. First you are bringing, so bank account debit to premium for goodwill. So bank account debit to premium for goodwill will come. That bank account debit to premium for goodwill will not be recorded in capital because capital account is not there in the entry. Okay, but this entry has a purpose when you are preparing capital account. Second entry for related to goodwill is sharing goodwill. Premium for goodwill account debit to sacrificing partners capital account, that we have already recorded in capital because capital is coming here. So two entries so far is there which is connected to this one, bank. So any entry that has some connection to cash at bank or cash or bank should be considered in this calculation. Okay, so 1,59,000 was there. Bank account was debited when the partner Aditya is bringing 4,50,000 capital, and also again for premium bringing we have recorded 2 lakhs. And as you can see, at the time of the person's admission, one more person invested additional money. Who was that? Yasmin invested 50,000 rupees additional. As you can see here, in Yasmin's capital account we have written by bank 50,000. That is also an entry related to bank. So all these entries here, if money is coming, you just have to add. Money is going out, you just have to deduct. So as you can see, 1,59,000 plus 4,50,000 plus 2 lakh plus 50,000. How much is there? So total it will come as 8,59,000. This is the amount that you have to show here in the balance sheet, new balance sheet. After this, you have to check whether there is any unrecorded asset to be recorded. There is no such asset in this question. Okay, there is no unrecorded asset, only unrecorded liability was there that we already considered. Now all these values we have to add: 7,35,000, 2,20,000, 1,45,000, 1,20,000, 8,59,000. Debit, liability side it will be 77,000, 1,19,000, 9,000 and 18,74,000. So when you add it, you will get 20,79,000. 20,79,000. 20,79,000 as the total. This is how we are supposed to do balance sheet related or capital account, revaluation account, capital account related question. We will be doing more of this kind of questions today. If you were not able to get it, obviously in the upcoming sessions the other doubts that you have in your mind will be cleared. Thank you.